Satoshi has 1.1 million Bitcoin. It's in a wallet because it was such an early stage wallet that is structured in a way that unless those coins are moved, they could be stolen if you had a quantum computer. And so Bitcoin has this unique little wrinkle of 1.1 million coins from a creator who no longer exists that are locked in a box that quantum will unpack. And so the Bitcoin blockchain uniquely is going to have to figure out what to do with that.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC-registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Welcome to this episode of The Bull of Wall Street. My name's Tally Leger. I'm the Chief Market Strategist at the Wealth Consulting Group. And as usual, I'm joined by my colleagues and co-hosts, Jimmy Lee, our CEO, and Jim Warden, CIO. And our special guest is my longtime collaborator, Matt Hogan, the CIO of Bitwise Asset Management. Welcome to the show, Matt.
Thanks, Tally. It's so good to be here. I'm honored to be on the show. Thanks for having me.
Well, I was thinking about this. Did you know that we've been connected for 11 years?
That's incredible. But that sounds about right. Yeah, we've known each other for a while now.
Well, so for those who don't know, Matt actually wrote the foreword for my book, and I brought a stage prop here, if you can see it. This is From Bear to Bull with ETFs. There's Matt down here. He wrote the foreword. So shameless plug for both of us.
That's right. That's right. Honored to have done it. Phenomenal book and phenomenal contribution. So great to see it.
Yeah, absolutely. And you might remember I spoke at your Global Macro Conference back in 2015.
Yep, absolutely.
So time flies.
It does. It does. A decade plus later, and here we are.
Well, so Matt Hogan, tell us now about Bitwise, what you're doing there and kind of where it sits in the broader digital asset space. For example, I want to know, and for our listeners, is it true that you guys created the world's first cryptocurrency index fund?
That is absolutely right. You and I go back my pre-Bitwise days. I've been at Bitwise for almost 8 years now. Before that was the CEO of ETF.com and watched, along with you, ETFs blossom into the primary way people invest. And after I sold that business, I looked around for the next big financial technology that people were skeptical of, but that I thought could be really significant, just like ETFs were. And crypto fit that bill. And absolutely, Bitwise created the world's first crypto index fund, among our other firsts. It's still today the largest crypto index fund in the world. Some people call it the S&P 500 of crypto. It's my favorite way to allocate. I think eventually indexing is going to be a very big deal in the crypto market, like it is in stocks and bonds and everywhere else.
That's awesome. Well, I mean, look, part of the reason for this episode and why we wanted to have you on is, we've got all these milestones for digital assets. Like, you got SEC approval of crypto ETFs, as you mentioned. You got related options on said ETFs. You got the launch of the BlackRock kind of counterpart to what you guys have already been doing, which has seen massive inflows. So asset managers like us are really seriously considering adding this alternative asset class. We talk about it all the time, but I don't want to get ahead of ourselves here. Let me kick it to Jimmy just to see if he can uncover some things about you, Matt, that we don't already know.
Hey, Matt, how are you?
Doing well, Jimmy. Good to see you.
We actually met at one of those RIA speed dating conferences a while back.
I remember that. Yep.
Anyways, well, not talking about crypto for a minute, and tell us more about your background. I know that it looks like you're at, was it wealthmanagement.com, Informa? Is it Inside ETFs?
Yeah.
And then before that, how'd you get your career started in finance?
That's a long story, but a fun one. I'll give you the 2-minute version. I was living in Maine, working a series of odd jobs. Believe it or not, I was a shoe salesman at L.L. Bean, and I was a minor league baseball mascot.
Awesome.
Wow.
Yes. How about that?
That's great.
You need someone to do the YMCA dance or the electric slide in a giant seal costume. I'm absolutely your man. But ultimately, that wasn't a long-term career path for me. And I read about a company called MetaMarkets, which was running the world's first transparent mutual fund. And this was back in the dot-com boom. And they were running a fund that disclosed its trades in real time. This was before the Qs launched. There were 1 or 2 ETFs, but it was before that. And they were really at the forefront of this idea of transparency, which really resonated with me. And so out of the blue, I wrote them a letter. I did some financial analysis, and they ultimately hired me to be an intern and then quickly a biotech analyst, then a biotech portfolio manager. A fun ETF fact for you is the person who hired me was Dave Noddick, who was the founder of that fund, who eventually came to work for me at ETF.com. So that took me off the mascotting path and into the financial path, because all of a sudden I was managing assets. And after that, a series of steps. So I helped that business for a while, then moved into the biotech industry. And then with Jim Wyatt, started ETF.com and grew that into a large business, becoming the CEO and selling it in 2015. It was after that sale that I worked at Informa doing wealth management as a managing director there for a couple of years. They bought our conference business. And then as soon as that was done, I moved into crypto. The thing that connects all of these things, except for baseball mascotting, is I love technologies that people are skeptical of. They were skeptical of biotech. That ended up being a big deal. They were very skeptical of ETFs. That ended up being a big deal. They've been very skeptical of crypto, but that is changing rapidly. And so I've tried to align my career with these industry growth driven by people coming to understand and appreciate new technologies. And I think crypto is just in the hockey stick part of that growth right now.
That's amazing. Were you a Savannah Banana?
I dream of being a Savannah Banana, maybe in my post-crypto world. I love those guys. No, I was Slugger the Sea Dog for the AA Portland, Maine baseball team. And it was quite a job, man. It was great.
Well, when you retire from Bitwise, you can buy the Savannah Bananas and then go from there. Make a movie or something.
This sounds like a life plan. This sounds like a life plan.
I think Jim has a question for you next.
Oh, I've got a bunch, but I'm just going to kind of start off. So I went to one of those conferences too, and so I've got the Bitwise hat. I think I met you, and I met Hunter. I remember Hunter saying something to me about, the first time that it was like $1 trillion worth of transactions that went over blockchain, and that just kind of blew my mind. Like, where did that come from? I mean, like, because it felt like, in 2016, 2017, this was just, no one really knew about it. And then all of a sudden, now you've got these lots of transactions, and then you have your ETFs, your crypto ETFs, and then it's not just Bitcoin, but Ethereum. And now you've got Ripple. And I mean, and we just hit like 100,000 not that long ago.
That's right.
So what do you think of all this huge transition?
It's really remarkable to see. You see stablecoins doing more transaction volume than Visa. You see the Bitcoin network moving money faster than JP Morgan. You see hundreds of millions of people around the world using these things. You see Starlink building its business on crypto rails for payments.
Wow.
That old tech meme or old tech idea. There was a book, I think it came from Gartner in early 1990s, called Crossing the Chasm. how most technologies go from early adopters, like your friend who always buys the latest gadget, to the mainstream. I think about cell phones doing that, right? When they were bag phones, and then suddenly we got the iPhone and we all had one. Or social media, which was like just kids in college, and then we blinked and your grandmother was using it. And I think crypto is going through that same crossing the chasm moment. Like even a year and a half ago, there were not major well-known firms in this space. Now BlackRock, manages whatever, 50, 70 billion dollars in Bitcoin. There were no Bitcoin ETFs. Now Bitcoin ETFs are the fastest growing ETFs of all time, right? The government was anti-crypto. Now the government is moving pro-crypto. The thing that connects all these is this idea of going from early adopters to the mainstream, and we're right at that moment. And so that's what I think is going on. But yeah, the numbers are really big and they're growing really fast, and it's really exciting.
Hey guys,
So-
before we get into
Yeah, go ahead, Jimmy.
more technical stuff, this podcast is primarily intended for financial advisors to listen in on and watch, but there's sometimes other people watching too. And then I would also say that not necessarily all financial advisors are well educated on crypto in general. So maybe like a primer, if you wouldn't mind, starting with like blockchain and like what that is, how it started, evolved into where we're at today with crypto.
Yeah, absolutely. The place where I'd like to start answering that, Jimmy, is by saying what it's not. Bitcoin's not a new way to buy coffee. I bought a coffee this morning from Pete's. It was great, and I paid with cash. I've actually never bought a coffee with Bitcoin, and yet I think it's the most important financial innovation over the last 20 years. So how can those things be true? I think a lot of people get thrown off because it's called a cryptocurrency, but we aren't using it yet like currency, and so they're skeptical of it. You're right to go to the idea of a blockchain. And here's the analogy I like to use when explaining the blockchain. We all use PayPal, right? You all have used PayPal or Venmo. Why can PayPal or Venmo move money instantly, whereas in the banking system, it takes multiple days for checks to clear? The reason is not that PayPal was created by Elon Musk and he's like an interstellar genius leading us into the future. The reason is really simple. PayPal is a closed database. So within PayPal, PayPal knows every account, every person. So if I say I want to send $100 to Tally, PayPal can look, it can see I have $100 and transfer it instantaneously, right? As fast as you can change one line in an Excel document.
Let me give you my account information.
Yeah, exactly. The reason banks are slow is because they're multiple databases.
Mm-hmm.
I have a JP Morgan account, you have a Wells Fargo account, I write you a check. JP Morgan has to check with Wells Fargo and make sure it's okay and have it clear. The way this ties to blockchain is the challenge with PayPal is it's a closed ecosystem. You can only send money to other PayPal users. What a blockchain is a solution to a computer science problem that actually existed for 30 or 40 years. That was debated at the NSA, at Stanford, at MIT. There's a series of papers on this, which is how do you have one database that's available literally everywhere in the world, that everyone can see into, that updates in real time, that's always accurate, but that's not controlled by any central party. So PayPal is one database that's closed and controlled by PayPal. A blockchain is one database available everywhere that's always accurate, updates in real time, but is not controlled by anyone. And the beautiful thing, once you figure out how to do this, and the Bitcoin blockchain was the first thing to figure out how to do this, is all of a sudden you can do a lot of things you've never been able to do before. You can move money at the speed of the internet to anyone in the world, right? PayPal, you can only send to PayPal, but I can send a Bitcoin to someone in Namibia and I get there instantaneously. You can then make money programmable because it doesn't have to stop at different banks. You can say, send it to Jim, but only if he tweets something that says Matt Hogan is a genius, and it can verify that and send it. You can do things like prime brokerage instantaneously, and you can have a database that you trust that won't change its rules over time to record property rights, right? The reason we trust Bitcoin is no one can alter it. If Mark Zuckerberg built a database of Zuckcoin, we wouldn't trust it because he could change it. So this blockchain, this one database available everywhere in the world that updates in real time, lets us move money at the speed of light, lets us program money, lets us have digital property rights for the first time. These are really big ideas. I think people get distracted by this word cryptocurrency because they think the only use case is to pay for coffee. No, the use cases are digital gold. The use cases are tokenized securities. The use cases are stablecoins, which are digital dollars that are available everywhere in the world. The use case is programmable money, which means we don't need as much middle or back office. And that's why it's attracted so many smart people and so much venture capital. That's probably more than you asked for, Jimmy, but I think that analogy of like PayPal, but global and open with no one controlling it is a good analogy for what a blockchain is.
That's great. And notice that I said digital assets, not cryptocurrency. I was being very sensitive. So let me ask a related question. And maybe this is a little bit where we probe here for our listeners. How do you address concerns about wallet security, or have those objections died down?
Well, it's gotten a lot better. The thing about a crypto asset is that it's a bearer instrument like cash, right? So I guess actually that's a good analogy too. I'm using lots of analogies today. If you think about my fiat currency that I own, I have maybe $100 in my wallet and then the rest of my money in the bank. If I lose my wallet, the $100 is gone, but the money in the bank is safe. Crypto is the same thing. You can have crypto in a wallet, which is what you're talking about. When you have crypto in a wallet, what you have is a password, and passwords can be lost, they can be hacked, they can be stolen, your phone could be SIM ported, someone could steal it. The other way to store crypto is with a qualified custodian, which uses a variety of security procedures to make sure that it's really safe. Bitwise stores its whatever $12 billion in crypto, whatever we hold for customers, with qualified custodians. And that's like putting money in a bank vault.
Yeah.
That's never been hacked. So the way I use wallets, on my phone, I have a crypto wallet. I primarily use it to pay fantasy football fees and other small things. It's got like $500 on here. If I lose it, that's sad, but it's not the end of the world. But most of my crypto wealth is at these qualified custodians. Actually, almost all of it is through Bitwise's funds. But that's the way to think of it. And it's gotten a lot better from the Wild West days when you only had the phone choice and people would, accidentally throw it out and then lose $1 million or something.
Yeah, I just think of the guy that was at the dump trying to find his computer and because it was worth a bunch of money and he had it stored on there.
Yes, yeah. Those stories are so ripe. The thing to remember about those stories is when he bought it, it was worth like $100, right? And so he probably just wrote down the password on a piece of paper and then lost it. And he woke up and it was worth $200 million. And then
Wow.
You find yourself digging in a trash dump. But those are the ghosts of crypto past. We move on into a new future now.
So I got to ask you about Satoshi Nakamoto. So this is the creator. I mean, and I guess number one, is it a real person? And number two, like, are they going to come out and advertise that, hey, I'm here and I'm worth $1 trillion? Like, what does that look like?
It's one of the great mysteries of crypto. The creator of Bitcoin, who synthesized all these scientific papers and then put them forward in a working package, who owns 1.1 million Bitcoin, which is
wow, 1.1 million. And how much is that worth?
It's $100 billion or something like that, a little bit more than that.
Wow.
So he's a wealthy individual, one of the wealthiest individuals in the world, but the coins haven't moved since he first mined them. So they haven't moved in 14 years. He hasn't posted anywhere in 14 years. No one knows who he is. It's a complete mystery. There are people who think it was this cryptographer named Hal Finney. There are people who's now passed away. There are people who think it was a government. I don't know. It's like the immaculate conception of financial assets. The idea, hopefully he never comes out. It's beautiful that he doesn't exist or isn't present, because it means there's no centralized figure holding sway. Bitcoin belongs to everyone. So the hope is that he never appears. But it is, I admit, a little weird to have a multi-trillion-dollar asset created by an anonymous person that no one can find. It's odd.
It's fascinating. But fast forward to now, and you've got Ethereum, you've got all these other, and you know, we had people coming out with their own coins. We have the Dogecoin, and now Ripple. Like, where do we go from here? Do we see some consolidation? And you know, does Ripple kind of take off? I don't. What do you think?
Great question. Can I put on my like professory hat and do two
Yeah.
why different crypto assets exist?
Yeah.
Awesome. So blockchains, every crypto asset is two things. It's the asset and the blockchain. Bitcoin asset, Bitcoin blockchain. Ethereum asset, Ethereum blockchain. The blockchains are just pieces of software. They're that database I described. And a piece of software can be optimized to be good at different things, right? Salesforce is a piece of software and Microsoft Word is a piece of software, but they do very different things.
Mm-hmm.
Bitcoin was the first blockchain, and as a piece of software, it's really simple. All it can do is hold Bitcoin, send it, receive it, and do a few small transactions, like a calculator. Ethereum, the second largest crypto asset, was developed after Bitcoin, and they said, it's cool you can send Bitcoin around the world. What if we could program it like we can program anything else? What if we could program Ethereum to act like the New York Stock Exchange or to hold things in escrow? So it can do a lot more than Bitcoin. Now, you may be wondering, Matt, why is Bitcoin more valuable than Ethereum? Because Ethereum can do more than Bitcoin. But in cybersecurity design, doing less makes your blockchain more secure. It doesn't update very frequently. There are no bugs. So people use Bitcoin as digital gold. You may have heard that term, because the software is optimized to be really secure. People use Ethereum as this like new internet because you can program it to move money in different ways, but they don't use it as digital gold because it's more flexible. You mentioned XRP and Solana and Avalanche and Sui. They're 40,000 blockchains. Sounds ridiculous from the outside perspective. But all of them are variations on the theme. What if we were like Ethereum, but faster? What if we were like Ethereum, but more modular with people building different things? The analogy I make is to the software space. There are 100,000 software startups. There are 10 that we use every day. We use Zoom, we use Word, we use Teams, we use Chrome, whatever, there are 10. Mostly, that's the way blockchains will be. There'll be a handful that we use every day. And then there'll be this enormous churn of people coming up with new ideas. And most of them will fail and be worth nothing. But every once in a while, you'll get a Slack. You'll get a Snowflake. You'll get a Salesforce. Every once in a while, you'll get a new idea that bubbles up and really is useful. And it'll just look like the rest of the space. To tie back to what we talked about at the beginning, the reason I love indexing, not to talk my book, is because who knows? Who knows? My family had a Betamax. That was wrong. I loved research in motion Blackberries. That was like, it's hard. I don't know what it's going to look like, but I bet it's going to look like the software space with a few giants, a lot of failures, and then a few that sort of struggle. And every once in a while, one pops up. So that's the way I would think of it, Jim.
Hey, can I just jump in?
Yeah.
I'll take it back to kind of a markets discussion a little bit. So, and you already touched on it, Matt. These massive flows around BlackRock's Bitcoin ETF. But I want to ask you about valuation. You know, as a practitioner, kind of a macro and a micro fundamental purist, if you will, without obvious fundamentals such as cash flows and earnings and dividend streams. You know, that's the way. Those are some of the things that we use to analyze stocks, for example. How do we value digital assets and these kind of alternative currencies? Are technicals and flows all we really have? What do you think?
Yeah, it's a great question. Unfortunately, the answer is complex, which is how we value Bitcoin is different from how we value other assets, because Bitcoin really has no cash flow. The way I think about Bitcoin is I use a total addressable market perspective. So for instance, I can look at Bitcoin as $2 trillion. I can think of it as gold for a digital generation. The gold market is about $18 trillion. So what's the right valuation for Bitcoin? Well, how likely is Bitcoin to reach the same level as gold? How long will it take? And what's the discount factor that you rate back from that? So if I say to you, I think Bitcoin is going to equal gold in 10 years, I have extremely high confidence that that will take place, but the discount rate today is 5%. I would figure out what the value of Bitcoin would be if it reached gold, which is about $900,000 per coin. And then I discount it backwards by 5% or 10% to add some risk on top of it, 10 years until we get to a net present value. And I know that's not a super satisfying answer, but it's honestly the best we can do. There are no cash flows. You have to look at addressable markets. You could argue the market is bigger than gold. You could argue it's smaller than gold. You could argue it has low probability. You could toggle the discount rate. But that's the closest you can get to sort of a CFA style analysis of Bitcoin's value.
That's helpful.
From my perspective, you'd be shocked. I think it's undervalued, but other people will tell you it's overvalued. It's certainly risky. Ethereum and other crypto assets actually have something that's a lot more like cash flow. When you use the Ethereum blockchain, you pay a fee in Ethereum. That fee is burned. You can measure that. It reduces the supply of Ethereum like a stock buyback. Ethereum did, let's call it $10 billion in revenue last year. So you can rate it on an ARR basis. You can call that earnings and rate it on something like a cash flow basis. But you can get a little bit closer to that traditional format outside of Bitcoin. But Bitcoin, there are no cash flows. It's all about this addressable market question and how big you think it'll be.
Can we stay there for a second and talk about Bitcoin in particular and markets?
Yeah.
From what I understand, there really hasn't been a lot of institutional adoption yet, but it seems like to me that we're at the very beginning stages of that, or it's been happening. What do you think from that perspective of institutional investors, pension funds, endowments, family offices, and then beyond that, maybe federal governments? I think I've asked that question to somebody else, using it as a reserve currency. Where do you see that going? Where are we at right now?
It's a great question. I think ultimately the majority of investors will have exposure to Bitcoin in their portfolio. And right now, the percentage of this professional money that does, Jimmy, is very low. It's maybe 5% of financial advisors, family offices, institutions have any allocation. BlackRock's talking about 1 to 2% in portfolios. If those people wanted to put 1 to 2% in Bitcoin, they have to buy like $1 trillion of Bitcoin. And it's only a $2 trillion asset. So, and that's before you get to governments, right? The US is talking about building a strategic Bitcoin reserve. There's a bill that would cause the government to buy 1 million Bitcoin. There are only 21 million that exist. And if the US government does, what about every other country on Earth? The last thing I'd say about this is there's not that much new Bitcoin. This year, 170,000 Bitcoin will be produced by mining. That's how much the supply will go up. The US government's talking about buying 1 million Bitcoin. Last year, the ETFs bought 500,000 Bitcoin. Public corporations bought 270,000 Bitcoin. If only 170,000 is being produced, but institutions need to buy 1 million Bitcoin and governments need to buy 1 million Bitcoin and corporations are going to buy 500,000 Bitcoin, that's where you get the short-term price appreciation, right? That's why the price was up 120% last year, because you have these new sources of demand and you have inelastic supply, and that causes the price to go up. That's not a guarantee, but that's what's been happening recently.
By the way, sorry, Jimmy, I was just going to say, everybody does already own Bitcoin. And this is me putting my fact checker cap on. So MicroStrategy was added to the NASDAQ 100. And of course, that's the software company that's been using all its cash to buy up Bitcoin. So it's in the index. Now we own it.
True. Good point. Good fact check. That is right.
Matt, do you see Bitcoin starting to decouple when it comes to correlation with the NASDAQ? Because it looked like it was basically a high-tech stock trade, and there was a lot of, just gambling going on in it. But what do you think? You think that's going to be a little bit different now with maybe more adoption from the mainstream?
Yeah, I think as it gets into it further into its use case, you're going to see those correlations come down. They're already low over long periods of time, but you're absolutely right. Over short windows, it's highly correlated to risk-based trades. I do think that's going to separate over time, because at the end of the day, what fundamentally drives Bitcoin is different from what fundamentally drives stocks, right? What fundamentally drives Bitcoin are these forces of new buyers coming into the market, are concerns about debt and debasement. What fundamentally drives stocks is economic growth, tax policy, corporate developments. So I think from a first principles perspective, you would expect them to have different returns. But Bitcoin's been so early in its journey that it's been trading partially like a risk asset. But I do think they'll decline over time. And, you know, I've written about how over long periods of time, it works as a non-correlated asset in a portfolio historically to boost your risk-adjusted returns really well. But I think that effect will stay in place for the coming years.
You know, I did want to ask you, when I met you, you said that at that time it was sort of at the beginning parts of NFTs, and then as NFTs were coming down, you know, it was a little crazy at that time. I remember you saying to me that it might have been as much as 95% of trades you said on NFTs were fake trades, and that you guys had written a white paper for the SEC for other cryptocurrencies, and that was the case. And so I'm going to ask you a question about regulation later, but when it comes to when it comes to that, you know, how's that even possible? Can you educate our audience here on how a fake trade actually even occurs, how that can potentially manipulate pricing, and if you think the old penny stock people were in Bitcoin and other cryptocurrencies, which I think they were, especially the NFTs, how that all worked. And then if you could, going back, I thought that the explanation of blockchain was brilliant for all the people that are going to listen to this. And I think it'd be great for us to also hear about things like stablecoins and how that maybe can affect, you know, the credit card business, like you already implied, and also other types of forms of crypto that are going to be, you know, use case type situations. But go ahead.
Yeah, I love it. Yeah, the first thing I did after coming into Bitwise, we wrote this big piece, which, as you said, pointed out that 95% of volume was fake. It's really not a great way to make friends in a new industry. If you're wondering, to come in and report that, it was picked up on the front page of the Wall Street Journal. You know what was happening there was crypto has all these international exchanges, often in very loose regulatory environments. It has some domestic exchanges that are now really big, like Coinbase and now the ETFs. But in 2018, when we wrote that, most of the trading volume that was reported was offshore, in offshore exchanges. And what was happening was those offshore exchanges were charging new assets, new crypto assets, new blockchains, new NFTs, etc., to list on their exchange. And the way they were competing for those listings was to artificially pump up their trading volume by just printing stuff on the tape. So it looked like, you know, what really tipped us off, we would look at the rankings, and, you know, we were big investors, so we knew where we traded and we knew where our friends traded, and we didn't recognize any of the top 20 names by trading volume. And the number one was this company called Coinbene, which had like 3 people on LinkedIn. And we just found it highly improbable that, you know, this company with 3 employees was doing much more volume than NYSE, NASDAQ, and, you know, the LSE combined. It just didn't seem right. So we dug into it, and sure enough, they were just wantonly faking it. That no longer exists. That's been cleaned out of the market. But it does point to something really important, which is, you know, crypto started as this anarchic, libertarian, anti-regulatory, mostly offshore industry, and it's going through this transition period to being fully regulated and on board and legitimate. And it's still in that journey. It's de-risked a lot. We now have qualified custodians that you can trust. We have listed ETFs that follow rules. We have adequate reporting. We have AML KYC, but it's still in this regulatory adjustment, right? And it's not, no one should buy crypto without acknowledging that it's still going through this process. And particularly as you get away from the large cap coins into asset 40, 50, 60, 70, 80, 100, 1,000, there's a lot of risk in there because there's not full disclosure, et cetera. On the larger coins, you're pretty secure, but on those smaller coins, you do still have a lot of risk, which is fun to analyze, but can be risky as an investor. I'm glad you brought up stablecoins. I think stablecoins are one of the most incredible killer apps that has ever been created. I think they're going to be a multi-trillion-dollar market, and I think everyone should be paying attention to them. What a stablecoin is a digital representation of a dollar. Everyone knows what a money market fund is. You give cash to a mutual fund provider and they invest it in short-term treasuries and they give you a certificate that trades. Stablecoin is like that, but it moves on a blockchain and doesn't pay interest. The reason stablecoins are so interesting is they do two things. First, they make it possible for anyone, anywhere in the world to have access to dollars that move at the speed of light with no costs. And while we take for granted our financial system in the US, when you go abroad, most people are dealing with currencies that debase at a rate of 10+% a year, and they have terrible financial frictions. So what you're seeing is broad adoption of stablecoins in emerging markets. I mentioned at the top, Stripe, which is one of the largest payment companies, acquired Bridge, which is a stablecoin payments company. The reason they acquired Bridge is who helps Starlink charge their customers in 100 different markets. Because if you wanted to serve 100 markets globally, are you going to set up a banking relationship in 100 different countries? Impossible. But with a stablecoin, anyone with a cell phone, which is everyone in the world, can pay you in dollars instantaneously for no fees. That's an absolute revolution. The second thing here at home, I know we don't talk about it much, but we pay 2% every time we charge something on a credit card.
Yeah.
It is gross. And stablecoins can do that transaction for, 10 basis points, a 90% reduction. I expect next year this year, Congress will pass stablecoin legislation, and you'll see JP Morgan, Bank of New York, and others enter this space. And I expect in 2 years or 3 years, you'll start to have the ability to do things like pay for things on Amazon with stablecoins and get a discount on your purchase instead of paying with credit cards. We shouldn't still be paying 2%. And I think this market is going to like 10 or 20x, just digital dollars.
Wow.
Everywhere. I think it's really exciting.
Can I just ask, so central banks like the Fed, they've been doing work on e-money, we used to call it, I want to say since the late 90s, early 2000s. So, your whole train of thought there, which was fascinating on stable coins. Thanks for that question, Jimmy, because that was the kind of transition here. I want to ask about the difference between those, which I think could have some really interesting real world applications for us, everybody on the call here and listeners, between those and central bank digital currencies, because they're really not the same thing. And is there like an obstacle, given those differences, for central banks adopting digital assets like these, because they're so, like, the whole point is they're decentralized, and then the central banks would lose complete control over their money supply?
Yeah, well, they would lose partial control because these stable coins still have to be backed by dollars. So in the end, what happens is you deposit treasuries with the stablecoin issuer and they issue you a certificate, and you can always redeem those. But it's a great question on CBDCs versus stablecoin. It comes down to how much you trust your government. My problem with a CBDC is that it gives the government the ability directly to freeze accounts or restrict transactions or interact with your money. The way our current financial system works is we have an intermediated financial system. In other words, the government can seize your assets, but it has to go through a bank to do it. And we have legal protections that make it jump that hoop. The issue with a CBDC is you remove that intermediary, and all of a sudden you have a wallet with the Fed. And if it doesn't like you, it can seize your money.
Yeah.
And regardless of what side of the aisle you're on, over the last 10 years, you've probably been antagonistic with one side or the other. No one wants that. The beauty of a stablecoin is you'll have that intermediated system, right? So if JP Morgan issues a stablecoin and the government wants to interact with you making a payment, it still has to subpoena JP Morgan. It has that intermediated protection. So I suspect you're going to see authoritarian regimes move down the path of CBDCs. But I suspect and hope we're going to retain some level of intermediation here in the US with legal protections. I know it sounds odd to say that crypto enables legal protections. That's like contrary to most people's views.
Yeah.
But on this question of stablecoins versus CBDCs, stablecoins enable those legal protections that, to me at least, seem like a good idea.
Thank you. Jim, jump in here.
Yeah, so I was going to just kind of ask about quantum. Quantum is starting to bubble up a little bit, and Jensen Huang said this is going to take 15 to 30 years. I tend to disagree. I think it could be 5 to 10 years, maybe less. But one of the concerns is that this is such high-powered computing that it could decrypt the crypto. Is that something at all of a concern, or do you just think we're just too far, or is crypto going to use quantum to make it more secure?
Yeah, it's the answer is it's 90% not a concern and 10% a concern. So the reason quantum is a threat is because what crypto is protected by is really long passwords, and they're so long that a traditional computer would take 1,000,000 years to guess your password, and a quantum computer could break that because it can guess everything at once, right? I'm not worried big picture because this same cryptography, it's called RSA cryptography, that underpins crypto, underpins military communications, point of sale transactions, the fundamental functioning of the internet. The point is that most of our modern world is built on this cryptography, which means they're really smart people creating quantum resistant cryptographic methods. And Bitcoin and others will adopt that. But there is a funny wrinkle. I do like to disclose full risk. We were talking about Satoshi. Satoshi has 1.1 million Bitcoin. It's in a wallet because it was such an early stage wallet that is structured in a way that unless those coins are moved, they could be stolen if you had a quantum computer. And so Bitcoin has this unique little wrinkle of 1.1 million coins from a creator who no longer exists that are locked in a box that quantum will unpack. And so the Bitcoin blockchain uniquely is going to have to figure out what to do with that. Does it freeze those assets until someone comes up and claims them? Does it do something else? But broadly speaking, I think we're going to figure it out. Otherwise, we're going to have insecure military communications and the internet's going to go down. And there's some smart people working on it.
Well, that sounds scary. I mean, if there is a problem, it's a lot more than just crypto. I'm thinking of defense and things like that.
100%.
So I wanted to pivot toward looking at crypto and wider adoption. Obviously, we've seen massive drawdowns and spikes. It feels like when things get there, when there's more adoption to something, there is a little bit more stability over time because you just have indexers and endowments. Is that something that you see with most of these large crypto assets, that over time maybe they don't have 80% drawdowns, maybe they're 30%? What do you think?
Yeah, I think that's right. They've already turned my hair white, so they can't do any more damage there.
At least you have some.
There you go. Exactly. I absolutely think that's the case. You think about the diversification of the type of investors in this market, from retail to retail plus advisors plus family offices plus institutions plus governments plus corporations. They all have different ways of approaching it. Some people now invest every month in their IRA through these ETFs. All of that will cause and has caused the volatility to decline. In fact, over the last couple years, Bitcoin's been about as volatile as the Mag 7. So still very volatile, but not like it used to be, right? Where you did see those 80% drawdowns. we'll still have drawdowns. You could still see 30, 40%, but I think the days of 80% are in the past. And I think that will continue over time as it matures.
And you probably also have more people buying on the dip too.
Yeah, you got
which we love that.
100%. And I think as you start to see it enter target date funds and target allocation funds and be in 529 plans and be in retirement plans, I know that sounds crazy, but it sounded crazy that BlackRock would be in this space 2 years ago, and here we are.
Yeah.
I think we're going to get to that point, and then you have persistent bids that's buying regardless of price, and that will further crush that fall.
Man, I want to go back to Valuation. Do you know David Sachs?
Yeah. I mean, I Bitwise knows David Sachs. He's an investor in Bitwise.
Good. Well, when it comes to regulation and what the holdups been for your industry and previously, how do you see that changing now under this new regime? What kind of opportunities open up because of that?
It's night and day. It's night and day. The last 4 years, the industry has faced regulatory lawfare from the SEC. There was a sitting senator who launched a quote unquote war on crypto. There was Operation Choke Point 2.0, which made it very difficult for crypto companies to get a bank account. That included Bitwise and others, and people were regularly debanked. It's hard to imagine sitting on the outside the degree of regulatory stifling that's occurred over the last couple of years. I didn't think it was possible. I was sort of a naive Bambi wandering into the Washington swamp and being surrounded by wolves. All of that, I think, is going to reverse. As you mentioned, Sachs is now the new crypto and AI czar. The Treasury head, the White House advisors, even in Congress, both on Republican and Democratic side, a very pro-crypto Congress. I think it's going to do a few things. One, we're going to get new laws that let things like major banks move into this space. Right now, they're not even allowed to touch crypto. And we're going to sort of take the cover off entrepreneurs building in this space. If you were an entrepreneur thinking about doing something new, would you really want to go into crypto where you're likely to be sued by the SEC or face subpoenas? Or would you rather go into another market that's more open and free? And I think you're going to see like a renaissance in new crypto apps. I really think it's going to be a golden age of crypto when this new administration comes in. Specific to crypto, without touching on bigger political rails, it's just been very oppressive over the last 4 years.
I have a friend that was created an exchange. He owns an exchange for tokenized assets. Mm-hmm. That's something else. That's tokens. I don't think a lot of advisors and or investors understand what that is. Can you talk about tokenizing assets? When I talk to people like you, or actually even money managers at traditional firms, they've been talking about tokens for a long time, actually. And in fact, my friend was involved with I think a company that had a money market fund that was tokenized years and years ago. So can you talk about that for our listeners?
Yeah, the place I would start is with how slow our existing markets are. Existing markets, I know it's wonderful in a way, but we trade 9:30 to 4, 5 days a week, and we take off holidays. The world operates 24/7, 365. Last year, we went to T+1 settlement. There was a Bloomberg headline that says, NYSE settles trades the fastest in 100 years. Think about that. Like, what other industry are we catching up to where we were in 1920 in terms of speed? And yet that's where we are with our traditional securities market. They're so sclerotic. What takes a day? Mm-hmm. I can get the elephant delivered from Amazon in like a few hours. It takes a day to settle stocks. It's crazy. So what tokenization is similar to that stablecoin example. You take the security and you create a token on it. The token lives on blockchain-based rails. And suddenly, you can settle transactions instantly. Suddenly, the market works 24/7, 365. Suddenly, you can list securities that aren't quite as painful to get available to the public. And this market has gone from basically nothing to about $20 billion a year ago to $50 billion this year. So it's growing triple-digit rates. BlackRock and others have launched money market funds that now command multi-billion dollars. that are approved to use as collateral for futures trades, I think it's a little bit like the early days of the ETF. In the early days of the ETF, everyone was skeptical and growth was slow. It was a few million, it was 100 million, maybe it was $1 billion, it was 2 billion. Now we wake up, there's $18 trillion. And I think tokenization is going to be the same thing. There are a lot of really smart people, sounds like, including your friends, who are building in this space because they realize that T+1 settlement and trading banking hours is not the future. The future is global, it's interconnected, it's 24/7, 365, it's instantaneous. And that can't happen on the traditional rails. It has to happen on tokenized rails. And I think once we get regulatory approval of crypto, once Bank of New York is comfortable custodying tokenized assets, this thing is going to start compounding at multiple hundreds of % per year. And we'll wake up again and it'll be like ETFs. Like, oh, there'll probably be a giant conference. If I was in my last business, I'd start a tokenized conference. I think it's going to happen. I think it's going to happen pretty fast.
So,
and doesn't that like remove a lot of inefficiency and like paperwork and like all these middle people that get involved? I mean, don't we get way more efficient with all of that?
Yeah, 100%. And it lowers costs and it opens up new opportunities. We still have people programming in COBOL. It really is shocking that, the financial services is in some ways the least disrupted market from technology, right? JP Morgan, the largest financial services company, was founded in the 1700s. What other industry is that true? And I think that's about to change because now we have global, we have 365, and it's in, not cryptocurrencies, it's in digital assets, blockchains, tokenized real world assets. And that's absolutely going to be the growth trajectory.
So Matt, it's the top of the hour. Is there something that you'd like to kind of help us close with that we haven't touched on you think is important?
I could talk about, this has been a great conversation. There is, I like to tell people what the largest risk is when investing in crypto, if I can, if that's an okay thing to say.
Yeah.
The largest risk is not technology, it's not adoption, it's not utility, it's not even valuation or volatility, although those are all worth considering. The single biggest risk in crypto is behavioral risk by the investor. For many people, this will be the most volatile asset that they own. And what I see all the time is people get excited during the bull markets and then panic and sell during the bear markets and have a short-term view. If you're going to invest in crypto, and no one has to, you want to invest for the long term. You want to invest with the right allocations such that if we do get, Jim, a 30%, 40% drawdown, you're not going to panic and sell. This behavioral risk, as it is in most of investing, is 2 or 3 or 4 times more important than the risks people sort of put on the headline. I think it's really important. It's a volatile asset. Understand that. It's very exciting. I think it should be in many portfolios, but understand the behavioral risk you're taking on.
I have a couple last questions before we end here, Matt, since we got you.
Yeah.
Privacy. A lot of people talk about blockchain giving privacy to the people that are doing business on it. You know where Satoshi's wallet was. And I would imagine that since everything is tracked on the blockchain and it's open source, tell us about privacy versus no privacy.
Yeah, it's a great question. It's sort of like some privacy is what you get with modern blockchains. As you said, it's traceable. So you can trace a Bitcoin transaction from point to point forever. But it's synonymously traceable. It's traceable from this numerical address to this numerical address to this numerical address. So you do have that protection. In practice, governments can subpoena exchanges to figure out who owns what wallet. So it's not perfect privacy, but it's pretty good privacy. It's much better privacy than writing a check with your name on it and who you're sending it to, right? At least it's disclosed. There are other cryptographic methods and certain corners of the crypto market that offer full privacy, but those raise regulatory concerns. So I think of it as intermediated privacy that's a little bit better than our current financial system, but still can adhere to AML KYC requirements is the sweet spot of where we're going.
And then one final question for me, and I don't know if anybody else has anything else, but are you at liberty to say from your compliance department what crypto you own aside from your own stuff?
Yeah, what do I own? So most of my money is in our index fund. Some of our money is in our Bitcoin ETF. And then do I own anything else? The rest, there's a little bit in like NFT that are going to zero, and in my fantasy football fees that are, in a variety of small cap assets. But I'm the world's most boring crypto investor. Just give me the index, give me the beta, and I think I'll wake up in 10 years and be just fine.
I like it. Well, look, we approach this whole conversation from the perspective of what we don't know about digital assets as opposed to what we know. So I think you really helped us out a lot there, Matt. Thank you.
Thanks. This has been
so
really
Matt,
fun.
I got one more question, final question, if you don't mind. So like with all, you mentioned the miners a while ago, with the price of Bitcoin being so high and all of these new developments with AI, do we see more people trying to mine or more companies trying to mine? Is this equivalent to like miners mining for gold? When the price of gold gets to a certain level, then they're going to mine more. I'm just curious how that works out with supply and demand.
And then maybe the energy play to that, Matt. Like
the energy play too, for sure.
Yeah. It's kind of like mining when gold prices get high, but there's one difference, which is the supply of Bitcoin is fixed. Mm-hmm. So with gold, if you apply a lot more effort, you can pull more gold out of the ground. With Bitcoin, you just have to apply more effort to try to compete for the same amount of Bitcoin. It's a challenging market, to be honest. The miners are attractive stocks right now, in part because they've negotiated low-cost power fees before the AI boom. So they've locked in power deals that now we have this massive AI boom, make them very competitive from a data center perspective. So I think they're like an interesting short-term trading opportunity for that. But at the end of the day, the Bitcoin mining business is kind of brutal. It's high capex, it's highly competitive, and sort of the system is designed to compete away your margin by making it just more difficult as the price goes up.
Oh yeah.
And you don't get more Bitcoin out of the ground. But I do think they're a good short-term opportunity, and they do have a reasonable beta to the Bitcoin space. On the energy side, it's a nuanced discussion. So first I would say, Jimmy, again, I keep saying this, there's Bitcoin and everything else. Basically everything else has moved to a new technology for running a blockchain called proof of stake, which doesn't consume any energy. Bitcoin uses something called proof of work, which is all these computers mashing algorithms and burning energy. So that's the first thing I would say. The second thing is the environmental story on it is mixed. Bitcoin mining has the highest renewable energy mix of any industry in the world. Because if you think about renewables, like particularly hydro, it's often in far-flung locations, far from cities, and a lot of the power gets wasted. And a Bitcoin miner can co-locate next to that. And in fact, we're seeing Bitcoin miners drive renewable energy development because it makes it more profitable. The flip side of that story is they can also co-locate next to coal power plants. And you see that too. From my perspective, and I come at this as a philosophy and environmental studies major in college, it's a net benefit because it incentivizes more renewable energy development. And I think the World Bank and the IMF and other people are coming around to this view, but it's not a perfect story. It does use energy, just like AI uses energy. So that there's some nuance there as well.
Come and dance on our floor.